This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Up until now, the personal allowance that we've been able to deduct from our net income has been a universally allowable £11,000. And the only thing that we've had to consider is the order in which we deduct that from the different types of net income that we have. We know what that order is. It is firstly non-savings, followed if necessary by savings, and finally by dividend income. And that would allow us to compute the taxable figures of each of those sources of income, as well as having the taxable income in total. We mentioned, however, that that was the usual personal allowance, and depending on what income you had, you may suffer some loss of a part or indeed the entirety of that personal allowance. And that's the part now that we've got to look at here in section 3 of these notes on chapter 2. As we've just said, what is the personal allowance? It's a level of tax-free income that, again, we thought all of us would enjoy, but we're about to discover that depending on how much net income, or to give the correct definition and description, as we'll see in a moment, adjusted net income, depending on what adjusted net income we have, we may see a reduction in the availability of that personal allowance. Indeed, we may lose all of that. So what does our note tell us here? We know what it is and we know the order in which it is deducted. We've seen that on page 5 on the pro forma computation. We've made reference to it many times before, from non-savings, then savings, then dividend income. As we know, the normal personal allowance is £11,000 here, but, and here's the issue, if the individual's adjusted net income, we'll refer to that as A&I in our lecture from now on, if that adjusted net income exceeds £100,000, then we're going to reduce the personal allowance. And we reduce it by this calculation here. We take in brackets the adjusted net income minus £100,000. So to the extent that adjusted net income exceeds 100,000, we will then take half of that, 50%, if you prefer percentages to fractions there. We take half of that excess of the adjusted net income compared to minus £100,000. We take half of that and reduce the personal allowance. Now, what that will mean is that once the adjusted net income is going to be £122,000 or more, when you put 122,000 into that calculation, 122 minus 100 is obviously 22,000 times a half is an £11,000 plus, go over 122 is more than £11,000 reduction in the personal allowance. Now, you never end up with a negative personal allowance, but if, as we say here, if the adjusted net income is £122,000 or more, the personal allowance is reduced to nil. In between 100 and 122, we've got this sliding scale. So we've got to calculate this adjusted net income, usually the same as the net income, but we calculate this adjusted net income, and having got that, compare it to 100,000, the excess divide by 2, take half of it, take 50% of it, and as long as that adjusted net income doesn't exceed 122, we'll work out the reduction in the available personal allowance and take the balance. Now, what is net income? We know that. Net income was your total income less either of two possible deductions, those qualifying loan interest payments or certain trading loss reliefs. But adjusted net income brings in a new concept that we'll look at in more detail a little bit later in these notes. But for this point, all we need to know is terms, and given the numbers, what to do with those numbers. More detail on each of the two items you're about to see will be forthcoming both later in this chapter and in relation to pension contributions, it'll be in chapter 10 as well. So adjusted net income is net income less the gross amount of personal pension contributions paid in the tax year, and also less any gross gift aid payments. But that, so we say, see section 5. Now, what we mean by gross, how we get the gross figure, we'll talk about in section 5, where we bring them into our examples. Now, I'll just tell you what the gross amount of these contributions or gift aid payments are. Description, explanation, and other details pertaining to them, that's for just a little bit later. But if you've got that number in a question, what do you do with it? That's what we need to sort out at this point in time. Okay, so adjusted net income less the gross amount of either or both of your personal pension contributions or gift aid payments. Okay, let's have a little example now to illustrate how we deal with this. Now again, I'll leave examples 8, 9 and 10 for you to have a go at on your own. But if we just go to a little setup that we're very used to, given what we've been looking at with your non-savings, savings and dividend income and your tax calculations. What do we do first of all? We calculate our net income. Now that will be analysed, non-savings. Here it's, what have I got there? Some £98,000. Not an overly clear number, but that is £98,000 there. Savings income 7,000. In this particular instance, the taxpayer doesn't have any dividend income. So the total amount of net income, 98 plus 7, 105,000. Now at this point, what we would usually do is just deduct the personal allowance of 11,000 from your non-savings income, which is very clearly big enough to absorb all of that personal allowance. So whatever personal allowance we get will be deducted from the non-savings income as well as in the total. But now we've got to see that our net income is £105,000. Depending on what figure of, if different, adjusted net income we get, if that exceeds 100,000, then that personal allowance of £11,000 is going to be restricted. Now, in this example, we may assume, you have not been told, that there were any personal pension contributions paid or gift aid payments made, whatever they may be. There weren't any. So your net income and your adjusted net income, they're exactly the same. So what do we do here? What is your personal allowance usually? It is £11,000. But we're now going to have to reduce that by the abatement, the reduction calculation that we saw. Now, how do we do that? Looking at the information there that we've got, we will take half times what is our adjusted net income. It is the same as net income, it's 105,000, minus the income limit. This income limit, by the way, of £100,000, if you've got your rates and allowances page still open there in front of you, on the first income tax section, you'll see that that income limit of 100,000 is given. Again, another number that you do not have to remember, but I think you probably will by the time, again, you come to the exam. So, 105 minus 100, that's £5,000. Half of 5,000 is 2,500. So the reduction in the personal allowance, given that adjusted net income exceeds £100,000, on this occasion is £2,500. That therefore reduces the personal allowance down from 11,000 by 2.5 to what? £8,500. So there we've computed your revised personal allowance. As soon as you've got that revised personal allowance, it's business as usual so far as the income tax computation is concerned. The 8,500 is now used and deducts, as we said a moment ago, is deducted rather, firstly from non-savings income, which is very clearly, very obviously, big enough, well big enough to absorb that deduction. So what does it leave us with? Our non-savings taxable income is now £89,500. The savings income still untouched at 7. So we're talking about a taxable income figure in total of some, what's that, 96,500. Let's just be careful on that. 105 minus 8,500 is indeed 96,500. So it cross-casts, we've got the right numbers. All right. Once you've coped with that part, it's then business as usual so far as the taxability of your taxable income is concerned. Now, again, this is something that you now should be able to handle. So what I'd like you to do, therefore, at this point, is to pause and then work out what you think is the tax on the figures here of taxable income. You've got £89,500 of non-savings, followed by 7,000 of savings, and we know that at a taxable income of 96,500, the taxpayer is very clearly a higher rate taxpayer. Can you work out for me, please, the tax thereon? Okay, well, let's see how you fared in terms of your calculation of that tax there. What we'll do here, as I've started to see, as you'll see on your screen in front of you, is to work that tax figure out. Now, again, I'm not bothered with the arithmetic on this. You can check that for yourself, but it's the structure, it's the formatting of the calculations of tax that concern us. Now, what we know is that we've got to begin with non-savings taxable income of £89,500. So non-savings is taxed first. £32,000 at 20%. Your basic rate band limit is fully used by non-savings. And the remaining, check my mental arithmetic, £57,500 to bring you up to the £89,500 of taxable non-saving income that you have. That's all in higher rate, so that's at 40%. So that's your non-savings income taxed at your normal standard rates, basic rate 20, higher rate 40%. Just like we were doing in example 1, indeed, all those lectures ago. Now the savings income. Very clearly, your taxable, again, non-savings income at 89,500 exceeds 5,000. And what does that mean? It means that there's no 0% starting rate band to utilise. Is there any dividend? Sorry, is there any I'll get it right in a moment. Is there any savings income nil rate band available? Yes, there is. The taxpayer is clearly, based on that taxable income figure, a higher rate taxpayer. Therefore, of that savings income of £7,000, the first 500 enjoys the savings income nil rate band. It is at 0%. That leaves £6,500, all of which is now in the higher rate band and therefore is at 40%, allowing us, once you've put those numbers through your calculator, to add them down and establish what then is your income tax liability. But look at that makeup again. As ever, non-savings income tax first. That there was your 89,500, basic rate band followed by higher rate band. Savings income, no 0% starting rate, but we do get the savings income nil rate band. For a higher rate taxpayer, £500 at 0%. 500 out of 7,000 now taxed, 6,500 the balance at, we're in the higher rate band and stay in it, therefore 40%. And thus you get the income tax liability. Okay. Now, having dealt with that example, what I would like you to do now, please, if you return to your notes, is that you will see there, example 8, for you to have a little go at, and also example 9. Now, in example 9, you will see that in addition to having non-savings income, that's your trading income, we've also got savings income, bank interest of 40,000, and we've got dividend income. We've got the set here. Dividend income totaling there some £36,000. And what that means, of course, is that very clearly we're going to be not just a higher rate, but an additional rate taxpayer. 130 plus 40 plus 36. We can see that we're clearly well over, well, a couple of numbers that will be relevant to you here. In terms of any personal allowance that would be available, do you think now, given those levels of income, 130 plus 40 is 170, plus 36 is 206, do we think that any personal allowance will be available? Now, I hope we're getting a resounding no on that. very clearly the adjusted net income is going to be in excess, well in excess at 206,000, well in excess of 122,000. So all of that personal allowance has been reduced down to nil. There is no personal allowance available. Now, on a Section C question, you would make that positive statement. As adjusted net income exceeds £122,000, no personal allowance is available. There'll be no need to show the calculation of how you get that outcome. The statement will be fine. Though when you look at the answer at the back, you'll see that both points are made. We do the calculation, it clearly gives you nil, or you can make the statement. Make the statement, it's fine. Obviously only involved in a written question. Objective test questions, there's no marks for that. Just get the answer. It means, therefore, that there's no personal allowance, so your net income and your taxable income will be the same. We can see here that we've got both non-savings that will go through basic rate and up into higher rate band. We've got interest income, clearly no 0% rate. The taxpayer at this level of income is an additional rate taxpayer. So not only do we have no 0% rate band, starting rate, there's no savings income nil rate band either to enjoy. Additional rate taxpayers do not get the savings income nil rate band, remember. And then the dividend income, well, it doesn't matter what level of taxpayer you are, the first £5,000 is taxed at the dividend income nil rate, nil, and the balance of it, well, that depends what band of income you're now in. Having taxed 130, having taxed another 40, we're up to 170, clearly in excess of £150,000, and therefore we're an additional rate taxpayer. And what that should mean is we're looking at the 38.1% rate applicable to all of that dividend income. But I would like you now to work through each of those examples, example 8 and example 9, and we'll see how we fare after that. So join me again, pause it at this point until such time as you've worked out and check through the answers to them with the example answers at the back. Do that for me now, please. Now, in each of the examples you've done there, in both example 8 and example 9, and the examples that we did earlier, what we've seen is that the net income is the same as the adjusted net income. Now, we know that there is a difference in terms of the definition, and that's dealt with there, as we've already mentioned, whereby from the net income we deduct what are referred to as the gross amount of personal pension contributions and or gift aid payments. Now, I haven't brought in those particular deductions into the calculation of adjusted net income to work out the personal allowance, because as we'll see in, I think it's section 5 coming up in just a short while, they, if they exist, have another impact on the income tax computation, which we're yet to see. All I need you to know at this particular point in time, that having got from the net income, if relevant, the adjusted net income, having taken away it's less the gross personal pension contribution and gift aid payments there. Having deducted down to get the adjusted net income, if that exceeds £100,000, then half of that excess is the amount by which we will restrict the available personal allowance. If, as we've said, we go above 122,000, then there's no calculation to do because the personal allowance will be zero. It will have been abated, it will have been reduced down to zero. Now, another question, you've done examples 8 and 9 there, I hope, without too much difficulty. Example 10 is another one you can have a go at. But a bit later, we will bring in the issue about those gift aid and personal pension contribution payments. So hold fire, you will see those later in this chapter. Okay, that said, therefore, now, let's just wind through our notes on and examples on the personal allowance as we've seen it, to come to, well, it's not a personal allowance issue, but at the sort of other end of the spectrum to what we've been looking at with the restrictions in that personal allowance. What we've seen with the restriction of the personal allowance is if that adjusted net income exceeds £100,000, then we're talking about a restriction of the personal allowance. We're talking about high taxable income individuals here. But down at the other end, you might have someone with a very low figure of net income. such that if their net income, for example, totalled only £10,000 with an available personal allowance of £11,000, they would have no taxable income. And unfortunately, the £1,000 worth of unused personal allowance that we see, 10,000 net income, 11,000 personal allowance, taxable income is nil, that unused personal allowance of £1,000 is wasted. What you can't do is, if you don't fully utilise a personal allowance this year, you can't carry it forward. Any unused allowances. We have that basic idea here, you use it or you lose it. That if you don't have sufficient income, then if there's spare personal allowance, fine. You don't pay any tax this year, you get another personal allowance next year, but you won't be able to carry that forward. Otherwise, it'd be a great idea, wouldn't it? That if you'd been to school until you were 18, went to university for 3 years, came out at 21, never having had any income, and say, oh, can I now have 21 years worth of unused personal allowances, please, to deduct from my income? No, it's not going to happen. So in which case, with a personal allowance, you use it or you lose it. But now what we're going to look at is a situation where, when dealing with spouses, and for purposes of spouses we include here civil partners, either exactly the same legislation. But what may happen is that you may transfer from one spouse to the other. As you see on the note here, there is a transferable amount of that personal allowance. Now, this is a fixed amount. Now, clearly it would make sense if one spouse had an unused personal allowance that we had the ability to transfer some part, if not the entirety, of that unused personal allowance to be used by the other spouse. Now, it's not quite as simplistic as that. There is a set rule. Now, I guess in terms of making it a set rule, then it cuts down on variables. You learn the rule, you apply the rule, job done. This sort of exercise probably far more likely to be a Section A objective testing question because it's very limited. There'd be very little income here to make it worthy of a big Section C written question there. So probably be looking at an objective testing question. But let's look at the notes and see what we're told about this. So it is an election here that may be made. It's available, as we've just said, to spouses or civil partners. And what the election is to transfer a fixed 10% of the personal allowance. So it's not a variable figure, a fixed amount, 10% of the personal allowance from one spouse to the other spouse there. The election is only available when both taxpayers are either just basic rate taxpayers or non-taxpayers. Now, the most likely situation and the only worthwhile situation for you to make this election would be, it's only likely to be made when one spouse is a non-taxpayer and therefore has an amount of unused personal allowance that, as we just said, you either use it or you lose it. And if you don't use it, it's going to be wasted. Now, that wastage, or that element, an element of that wastage could be avoided, because what you could do is to transfer this fixed amount across. This fixed amount there, fixed 10% of the personal allowance. Now, you know that the personal allowance is 11,000, so a fixed amount of that 10% of 11,000 will be 1,100. Now, before you then start thinking, oh, so that increases the personal allowance of the transferee spouse, hold fire. But the amount that is based on 10%. Okay, we said it's only going to be worthwhile. You only do it if one spouse was otherwise having an unused amount of personal allowance, but it's only available if the other spouse is just a basic rate taxpayer. If either spouse is higher or additional rate taxpayer, this election is not available to you. So it's either, and most likely, from non-taxpayer to basic rate taxpayer spouse, or you could do it from basic to basic, but it's less likely, there's no good reason to do that. It's where otherwise, in the hands of the transferor spouse, an amount of that personal allowance would have been wasted. Now, there's a time period. The election here must be made within 4 years of the end of the tax year to which it should apply. But if you do it within the tax year concerned, the election will remain in force for future years until you withdraw it. So if you make it during the year, it applies not just to the year, the tax year that is, but the future tax years. You're not bound by that, you can withdraw it at any point in the future. Or otherwise, if you're coming at this after the event, then you've got to make it within 4 years, and then you make it in relation to each year. How does this work? Now, it's very easy to know what the amount to transfer is. It's 10% of £11,000, which is £1,100. But the relief is given as a tax credit to be deducted in deriving the tax liability of the transferee taxpayer, the person to whom the transfer has been made. It goes from transferor to transferee spouse. But it is not given as an extra increased personal allowance. Instead, it's given as a tax credit, a reduction in your tax charge. And it's computed as 20% basic rate of tax, 20% of the transferred personal allowance, which of course for our tax year, 16-17, would be, as we know, 10% of 11,000 will be £1,100. At a tax credit rate of basic rate 20% is 220. That amount would then be deducted in deriving your tax liability. But if your tax liability before this was otherwise less than £220, you can't have a repayment. All this would do is to reduce then that lower, £100, 150, 200, whatever it might be, that figure down to zero. So it'll save that amount of tax liability. But otherwise, you get to deduct £220 in your tax liability calculation. The amount of the transferable personal allowance will be given in the tax rates. So again, if you're looking at your rates and allowances page now, you'll see reference to that. That's given to you, but you obviously have to know how to apply this. You may see in other texts references to either the marriage allowance or marriage tax allowance. That's the same thing. So don't think there's some new thing there that you've never heard of. It's just another name for the transferable amount of the personal allowance. So literally, in terms of applying it, it's only going to be when you've got either spouses or civil partners, where one is a non-taxpayer because their level of income is less than the personal allowance, and the other spouse is just a basic rate taxpayer, not higher, not additional, just a basic rate taxpayer. Let's have a little look at our example here, therefore, example 11, to illustrate this. Right, we've got probably names people are unlikely to be at the lower end of the taxable income spectrum here. But we've got young David and Victoria. They're married, and in 16-17, David had a trading income assessment of £8,000, while Victoria received a salary of £30,000. Now, just looking at those numbers before we then see the requirement, what have we got? Trading income assessment for David, £8,000. £8,000 is less than £11,000. Clearly a non-taxpayer and with a wasted amount of their personal allowance. Not all of that wasted amount can be preserved, but this is the ideal situation where David would elect here to transfer that fixed amount of 10% of their personal allowance across to spouse Victoria. Now again, you can't get all of the unused personal allowance transferred, just that fixed amount. Why would it be available here? Not just because David has an unused personal allowance, which is the reason why we look to do it, but the only reason why it's available is that the transferee spouse, young Victoria here, she is a basic rate taxpayer with a salary of £30,000, alone the deduction of the personal allowance. We know we're well below the higher rate threshold, the basic rate band limit of £32,000. So Victoria is indeed a basic rate taxpayer. Right, so what have we got to do? calculate the income tax liabilities for both David and Victoria, assuming that an election is made to transfer 10% of David's personal allowance to Victoria and state the date by which the election should be made. Now, obviously, stating that date is just following the rule, and that's something that you'll get to grips with later as you go through. But let's have a little look at how we would now attempt to answer that. Remember that from the day that you're born, you have your own existence in taxation, and whether you're single, married, whatever, you all get your own individual personal allowance. But where there are spouses or civil partners, there are various relaxed rules, advantages we might call them, for being in that relationship in certain issues. This is the first of those issues that we will see. So here, David, let's look at his income tax computation to begin with. Now, we know that with a salary level, a trading profit, I beg your pardon, trading income assessment of only £8,000 and no other sources of income, that very clearly he's going to be a non-taxpayer. But what would his computation look like? Now, again, we've got one source of income, trading profit. Now, again, to do it right, you'd have your analysis column, trading profit, obviously not savings, and total. But there is only one figure, so it's going to be very easy, and there's going to be no tax to compute. So I'm not going to bother here with those analysis columns, and hopefully you'll understand the reason why we can ignore it. So trading profit is £8,000, from which we can then deduct the available personal allowance. Now, with the election in force, instead of getting the full 11,000, we have chosen, of course, to transfer 10% of that figure. That was £1,100. So the remaining available personal allowance to deduct would be £9,900, methinks. Now, 99 is obviously bigger than £8,000, so it means that the taxable income here is simply nil. The taxable income is nil. But rather than wasting 8,000 compared to 11, some £3,000 of the personal allowance, 10% of that personal allowance, some £1,100, the benefit of that in the form of a tax credit is able and will now be transferred across to Victoria. So let's have a little look at Victoria's computation now. Now, Victoria has one source of income. She's got employment income, a salary there. Now, again, a salary is non-trading income, it's trading income, but it's non-savings income, beg your pardon. The salary there is non-savings income, just as the trading profit of David is. So I'm going to abandon, with your permission here, the analysis column. Salary, what did she have? £30,000. Now, what personal allowance does she have? She has her basic personal allowance of £11,000. That does not change. It is just 11,000. That brings her down to a taxable income figure of some £19,000. Now, how would we then tax that £19,000? Now, we know that it is non-savings income. You have to forgive me here with a little bit of space still left available for me to squeeze it in. 19,000 of non-savings taxable income. All of that is in the basic rate band, so it would be times 20%. 20% of 19,000, 2 times 1,900 is what? £3,800 there. 3,800. Now that would have been it, but with the election having been made here, that was to give this benefit of the transferred amount of the personal allowance in the form of a personal allowance tax reduction. And how much is that? Well, we know 10% of the personal allowance was transferred. That was 1,100 at 20%, and And as the note above this, as we've seen, has stated, that's a reduction in tax of £220. Take away your 220, and that would leave you with what? 3,580. But again, you'll see a better version of this in the example answers for you to have a little look through for yourself there. But it is that transferred amount, 10% fixed amount. Again, there's no provision for any other figure. It is just that 10% figure, the 1,100 that's transferred. It doesn't go as an extra personal allowance to the transferee spouse. No, it goes as this tax credit. 1,100 at 20% is £220. That is, well, deducted here, as you can see, in full, because the tax figure from which you're deducting it is well in excess of 220. If, of course, the figure you were deducting it from was less than 220, it would simply give you nil as the tax liability. Okay, so different issues, therefore, that may pertain to the use of the personal allowance and the calculation of the personal allowance available to spouses. Again, if not already, have a go at example 10, revise back through their example 11, and we look forward to seeing you again in our next session together.